Welcome, financial enthusiasts and curious minds. Ever wondered why some people struggle to build wealth, while others seem to have it all figured out? Well, today we introduce you to the 23 wealth killers no one talks about. You might be thinking, wealth killers? That sounds intense. And you're right, these are the sneaky, often overlooked factors that can drain your finances and hinder your financial growth. They're like termites, silently gnawing away at the foundations of your wealth. Let's picture this. You've got a decent income, you've got a savings plan, you've paid off your debts, you're doing everything right. But still, your financial growth seems stunted. Why is that? The answer often lies in these wealth killers. Wealth killers are not just about big, obvious expenses, they're about the small, insidious drains on your finances that add up over time. They're about paying a little too much here, saving a little too little there, and making decisions that seem good in the short term, but have long-term financial consequences. But don't worry. Identifying these wealth killers is the first step towards defeating them. After all, knowledge is power, and with the right strategies and a bit of discipline, you can overcome these wealth killers and build a solid financial future. So, are you ready to dive into these wealth killers? Are you ready to take control of your financial destiny and say goodbye to these silent saboteurs of your wealth? Let's get started. Wealth killer number 1 and number 2, your home and your car. Surprised? Let's unfold the mystery. Welcome to the world of the home and car trap. Now don't get us wrong. We're not saying that owning a home or a car is a bad thing, but what we are saying is that they can become significant financial burdens if not managed correctly. Consider this. Your home is your castle, your sanctuary, but it's also a source of high maintenance costs, property taxes, and mortgage payments. The bigger the house, the higher these costs. You might be living in your dream home, but are you prepared for the financial demands it places on you? From fixing that leaky roof to paying the annual property taxes, the costs can quickly add up, making your dream home more of a financial nightmare. And let's not forget about your car. That shiny piece of metal on wheels might give you the freedom to go wherever you want. But at what cost? Cars depreciate faster than you can say 0 to 60. The moment you drive a new car off the lot, it loses a significant portion of its value. Add to that the costs of repairs, insurance, and fuel, and you have a depreciating asset that keeps taking money out of your pocket. Remember, every dollar you spend on maintaining your home and car is a dollar less you have for investing in wealth-building assets. The key here is balance. It's about understanding the potential financial impact of your decisions and making choices that align with your financial goals. So the next time you're thinking about upgrading to a bigger house or a newer car, pause for a moment. Consider the financial implications and ask yourself, is this going to help me build wealth, or is it going to become another trap that drains my resources? So before you splurge on that dream house or car, consider the potential financial burden. Because understanding these wealth killers is the first step towards building a stable and prosperous financial future. Wealth killer number 3, being too cheap. Yes, you heard it right. It's a common misconception that being cheap is the best way to save money. But let's break down this myth and get to the heart of the matter. You see, there's a fine line between being frugal and being cheap, and crossing it could lead to what we call a false economy. False economy, ladies and gentlemen, is when you think you're saving money, but in reality you're setting yourself up for larger expenses down the road. It's the classic tale of buying a pair of shoes on sale, only to have them fall apart after a few months, forcing you to buy another pair, or choosing the cheapest contractor to fix your roof, only to end up with a leaky ceiling and a more costly repair. In essence, being too cheap often means sacrificing quality for cost, and while it might save you a dime today, it could cost you $1 tomorrow. Quality, as they say, has a price. And sometimes it's worth paying a little extra for something that will last longer or perform better. Now, don't get me wrong, I'm not suggesting you splurge on the most expensive items or services out there. It's about finding a balance. It's about understanding the value of things, not just their price tag. It's about making smart, informed decisions that take into account not just the initial cost, but also the long-term implications. So, the next time you're faced with a choice, don't just go for the cheapest option. Do your research, weigh the pros and cons, and consider the potential long-term costs. Because sometimes the most economical choice isn't the cheapest one. It's the one that offers the best value for your money. Remember, sometimes it's worth paying a bit more for quality. And if you're enjoying the video so far, don't forget to hit that subscribe button and ring the notification bell. Wealth killers number 4 and number 5, impulse investing and short-term loans. These are big ones. Let's dive into the world of impulse investing first. Picture this. You're scrolling through your social media feed and suddenly, you spot a post about a hot new stock that's projected to skyrocket. Without much thought, you decide to jump on the bandwagon and invest. This, my friends, is the classic case of impulse investing. It's akin to riding a financial roller coaster without a safety harness. Sure, the thrill is exhilarating, but the potential for damaging falls is high. By making hasty investment decisions based on trends or hearsay, we expose ourselves to financial losses and high transaction fees. It's always better to take a step back, research, and make informed decisions rather than getting swayed by the latest trend. Now let's talk about another wealth killer, short-term loans. Imagine you're in a tight spot and you need quick cash. The lure of short-term high-interest loans can seem like a lifesaver. But here's the catch. The interest rates on these loans can be staggeringly high, which can quickly accumulate, leading to a vicious cycle of debt. It's like trying to fill a bucket with a gaping hole at the bottom. You're constantly playing catch-up, but the debt just keeps piling up. So what's the solution? It's simple. Plan and save for emergencies so you can avoid the need for such loans. And if you ever find yourself considering a short-term loan, ensure you have a clear plan for how to repay it before you take it on. When we let impulse guide our financial decisions, we're essentially gambling with our hard-earned money. Whether it's investing in the latest hot stock or taking out a high-interest short-term loan, the risks are high and the consequences can be severe. The takeaway? Always think twice before making financial decisions on a whim, because in the world of personal finance, slow and steady really does win the race. Wealth killers number 6 and number 7, impulse purchases and investment chasing. Sounds familiar? Now let's face it, we've all been victims of the buy now button at some point. It's that moment when you're scrolling through your favorite online store and you see that item you just must have. It's not something you need, it's not even something you planned for, but it's just so tempting. That, my dear friends, is the peril of impulse purchases. These unplanned buys can quickly add up, and before you know it, you're in a financial drain. It's like eating a whole bag of chips when you're not hungry. It feels great at the moment, but you'll regret it later. Moving on to our next villain, investment chasing. This is the financial equivalent of going on a wild goose chase. It's the practice of constantly switching investments in pursuit of the next hot stock or trend. It's like trying to catch a wave with a fishing net. You're more likely to get wet than succeed. Each time you hop from one investment to another, you're not only likely to miss the best times to buy and sell, but you're also racking up transaction costs. And let's not forget, there's no guarantee that the new investment will perform any better than the last. So why do we fall for these traps? Well, it's often a mix of FOMO, the fear of missing out, and the thrill of the chase. But remember, building wealth isn't a sprint, it's a marathon. It requires patience, discipline, and a well-thought-out plan. So the next time you're tempted by that must-have item or the next big thing in investing, pause and consider the potential financial impact. It's better to miss a chance than to make a bad choice. And if you're finding these insights useful, why not hit the like button? It would mean a lot to us. Stay tuned for more wealth killers lurking in the shadows. Wealth killers number 8 and number 9. Overly conservative investing and neglecting to refinance loans. Let's dig in. Let's start with overly conservative investing. Picture this. You've worked hard, saved up, and now you're looking at a fat stack of money. Now what? The idea of losing any of it sounds terrifying, so you decide to play it safe and keep it in a low-yield savings account. But here's the catch. While your money is sitting there, it's missing out on the growth it could be experiencing in the market. This is like having a golden goose, but feeding it just enough to keep it alive, not enough to lay golden eggs. You see, the potential growth from investing in a diversified portfolio can significantly outpace the interest earned in a savings account. So, while it's wise not to put all your eggs in one basket, being overly conservative can lead to lost financial growth. Now let's talk about the second wealth killer, Neglecting to refinance loans. Imagine you've taken a loan with a high interest rate. Over time, interest rates drop, but you stick with your original loan terms. It's kind of like sticking with a flip phone when everyone else has moved on to smartphones. Refinancing your loans when interest rates drop can significantly reduce your monthly payments and the total amount you pay over the life of the loan. By not refinancing, you're essentially giving away money that could have been used to grow your wealth. So keep an eye on those interest rates and don't be afraid to negotiate for better loan terms. To sum it up, both overly conservative investing and neglecting to refinance loans are like running a marathon with weights on. They slow down your journey to wealth accumulation. But remember, it's never too late to make a change. So take off those weights and run free. Invest wisely, refinance when beneficial, and watch your wealth grow. Remember, a balanced approach to investing and smart loan management can go a long way in building wealth. Wealth killer number 10. High fees and commissions. This one's a silent wealth killer. Imagine this, you're on a road trip and your goal is to reach a destination that's 1,000 miles away. But for every 100 miles you drive, your car guzzles up a quarter of your fuel. Now that's a significant chunk. Similarly, when you're on the journey towards financial freedom, high fees and commissions can act like that fuel-guzzling car, draining your wealth bit by bit. Let's take a closer look at how this happens. Every time you make an investment, there may be fees and commissions involved. These costs could include brokerage fees, annual fees, transaction fees, and even performance fees. These might seem small and insignificant when you're starting out, but over time they add up, and before you know it, they've eaten a considerable chunk of your returns. Think of it like a leaky bucket. You're pouring money into the bucket in the form of investments, hoping it will fill up over time, but fees and commissions are like tiny holes in the bucket, slowly draining away your wealth. And the more investments you make, the more holes appear. So what's the solution? Well, it's simple. Keep an eye on those fees and commissions. When choosing an investment, don't just look at the potential returns. Consider the costs as well. Look for low-cost investment options like index funds, which typically have lower fees than actively managed funds. And remember, every dollar you save on fees is a dollar that can be reinvested to grow your wealth. Let's not forget about those sneaky commissions either. They can be a silent killer, often hidden in the fine print. So, always make sure to read the fine print before making an investment. In conclusion, high fees and commissions are like termites. They may not cause noticeable damage at first, but over time, they can destroy your financial house from the inside out. Be sure to keep a close eye on those fees and commissions. They might be eating away at your wealth without you even realizing it. Wealth killers number 11 and number 12, paying minimum on debts and ignoring retirement planning. These are long-term wealth killers. Let's dive deep into the abyss of wealth destruction, starting with paying only the minimum on your debts. This might seem like a good way to keep your head above water, but it's like trying to swim upstream with a boulder tied to your ankle. You're not really moving forward, you're just not sinking. When you pay only the minimum on your credit card debts, you're essentially giving a free pass to the interest to multiply and feast on your hard-earned money. It's a slow burn that results in long-term debt accumulation. It's like a snowball rolling down a hill, picking up more snow and momentum as it goes. Before you know it, you're stuck in a blizzard of debt that's hard to dig yourself out of. Now let's shift gears and talk about ignoring retirement planning. It's easy to put off thinking about retirement when it seems like a distant future. But time has a sneaky way of speeding up, and before you know it, you'll be trading your work boots for slippers. Failing to plan for retirement is like setting off on a road trip without a map or GPS. You might enjoy the journey for a while, but eventually, you're going to run out of gas, and you'll find yourself stranded in the middle of nowhere. The repercussions of this can be severe. Insufficient savings, increased financial stress, and a retirement that's more of a struggle than a rest. So, what's the takeaway here? It's simple, really. Start planning for your retirement today, not tomorrow, not next year, but today. And when it comes to your debts, don't just pay the minimum. Pay as much as you can, as often as you can. It's like fighting a fire. The more water you throw at it, the quicker it'll go out. So start planning for your retirement today, and make sure to pay more than just the minimum on your debts. Wealth killers number 13 and 14, uninsured risks and neglecting tax planning. Let's shed some light on these. Imagine a tightrope walker performing without a safety net. Risky, right? That's what you're doing when you neglect to insure against significant risks. Whether it's health issues, property damage, or liability, unforeseen events can strike at any moment. And without the right insurance coverage, you could face large, unexpected expenses that can quickly drain your wealth. It's like being hit by a financial bus you never saw coming. Now let's switch gears and talk about taxes. Taxes, as we all know, are as certain as death. But just because they're inevitable doesn't mean you should pay more than necessary. That's where tax planning comes in. Poor tax planning, or worse, no tax planning at all, can lead to higher taxes. This can reduce the amount of money you have available for saving and investing. It's like having a hole in your pocket. The more you earn, the more you lose. Think of tax planning as a strategic game. The goal is to arrange your financial affairs in a way that minimizes your tax liability. This could involve making use of tax deductions, credits, or planning your investments in a tax-efficient manner. It's not about evading taxes, but about making smart decisions that allow you to keep more of what's yours. In essence, uninsured risks are like walking a tightrope without a safety net, and neglecting tax planning is like having a hole in your pocket. They are silent wealth killers that can creep up on you and wreak havoc on your financial health. So don't be that tightrope walker without a safety net. Don't let your hard-earned money slip through the holes in your pocket. Take steps to insure against significant risks and plan your taxes efficiently. Remember, insurance is not a luxury, it's a necessity. And when it comes to taxes, planning is key. Wealth killers number 15 and 16, lack of emergency fund and succumbing to peer pressure. Let's unravel these common traps. Picture this, you're sailing smoothly on the sea of financial stability. Suddenly, an unexpected storm hits. Your car breaks down or you're faced with a medical emergency. Without an emergency fund, this sudden expense can capsize your boat, forcing you to take on debt to stay afloat. An emergency fund is your lifeboat in the stormy sea of life's unexpected expenses. It's your buffer against financial stress and debt. Now let's talk about the 12th wealth killer, peer pressure. Imagine you're at a party and everyone around you is flaunting their latest gadgets, vacations, or designer clothes. It's tempting to try and keep up, to match their spending habits. But giving in to this peer pressure can lead to unnecessary expenses, pushing you into a cycle of debt and financial strain. Remember, everyone's financial journey is different. What works for others may not work for you, so resist the urge to keep up with the Joneses. Instead, focus on your financial goals and what you can afford. In conclusion, both a lack of an emergency fund and succumbing to peer pressure can lead to unnecessary debt and financial stress. So, start building your emergency fund today, and remember, it's okay to say no to unnecessary expenses. Your future self will thank you for it. Moving on to wealth killers number 17 and 18, poor health habits and underestimating lifespan. Let's shed some light on these silent saboteurs. Imagine your body as the vehicle that carries you through the journey of life. Like any vehicle, it requires regular maintenance to run efficiently. Poor health habits like smoking, excessive drinking, lack of exercise, and unhealthy eating can lead to chronic diseases. These not only affect your quality of life, but can also lead to higher medical expenses. Moreover, a deteriorating health condition can reduce your ability to work and earn income, putting a significant dent in your wealth. So, make a commitment today to adopt healthier habits. Your body and your wallet will thank you for it. Now let's talk about the 19th wealth killer, underestimating lifespan. With advancements in healthcare and technology, people are living longer than ever before. But are you financially prepared for a longer lifespan? Failing to plan for a long life can result in running out of money in retirement, forcing you to compromise on your lifestyle or rely on others for support. So it's crucial to start planning for retirement early, taking into account the possibility of living longer than you anticipate. Consider strategies like maximizing your retirement contributions, investing wisely, and exploring annuities or other income-generating assets. Remember, it's never too early to start planning for retirement. To wrap up, both poor health habits and underestimating lifespan can silently sabotage your wealth. So invest in your health and plan for a long life. After all, your wealth is not just about money, it's about living a long, healthy, and fulfilling life. Stay healthy, Plan for a long life, and remember, it's never too early to start planning for retirement. Next up, wealth killers number 20 and number 21. Lack of financial education and ignoring inflation. These are two subtle yet equally devastating threats to your wealth. Starting with lack of financial education. It's said that knowledge is power, but in the financial world, lack of knowledge can lead to a loss of power over your financial destiny. Without a solid understanding of basic financial concepts like budgeting, investing, and retirement planning, you may find yourself making costly mistakes that can erode your wealth over time. You might miss out on opportunities to grow your wealth, become susceptible to scams, or end up in unnecessary debt. So, make financial education a priority. Read books, take courses, listen to podcasts, or consult with a financial advisor. The more you know, the better equipped you'll be to make smart financial decisions that can help build and preserve your wealth. Now let's talk about ignoring inflation, the 16th wealth killer. Inflation is like a slow leak in your tire. You may not notice it at first, but over time it can leave you stranded. With inflation, the purchasing power of your money decreases over time. If your investments aren't earning a return that outpaces inflation, your wealth is effectively shrinking. It's crucial to factor in inflation when planning for retirement and making investment decisions. Invest in assets that have the potential to grow at a rate higher than inflation to preserve and grow your wealth. In conclusion, both lack of financial education and ignoring inflation can quietly chip away at your wealth if not addressed. Equip yourself with financial knowledge and always keep an eye on inflation. Remember, financial success is not just about making money, it's about preserving and growing that money over time. Stay informed, stay vigilant, and keep inflation in check. Wealth killers number 22 and 23, overleverage and scams. These are serious wealth killers. Let's delve into the murky waters of overleverage first. Imagine you're a financial daredevil. You borrow heavily to invest, hoping that your returns will outpace your debt. This is like trying to outrun a cheetah while wearing lead boots. It might work, but if it doesn't, you're in for a world of hurt. If your investments underperform or worse, tank completely, you're left holding a colossal bag of debt. The financial strain can be crippling and can lead to a rapid depletion of your wealth. So folks, the moral of the story, don't bite off more than you can chew. Moving on to scams, the number 23 wealth killer. Picture this. An email lands in your inbox promising a fantastic investment opportunity with astronomical returns. It might be exciting, but remember, if it sounds too good to be true, it probably is. Scams are designed to part you from your hard-earned money. They're like piranhas in a goldfish bowl, and you're the goldfish. Falling victim to financial scams or fraud can lead to significant financial loss. It's not just about the money, it can shatter your trust and confidence, leaving lasting emotional scars. So, how do you protect yourself? Be skeptical. Do your due diligence. Check and double-check before parting with your money. It's better to miss out on a once-in-a-lifetime opportunity than to lose a lifetime of savings. In the end, both over-leverage and scams come down to one thing: risk management. It's about knowing your risk tolerance, understanding the risks involved in an investment, and taking steps to mitigate those risks. It's about being smart with your money and not letting greed or fear cloud your judgment. Stay safe, stay smart, and remember, if it sounds too good to be true, it probably is. So there you have it, the 23 wealth killers no one talks about. We hope you found this video informative and helpful. We've explored the numerous pitfalls that can drain your wealth if not managed properly. From the high costs of home ownership and car maintenance to the hidden expenses of being too cheap or falling for impulse purchases. We've highlighted the dangers of hasty investment decisions, the cycle of debt that can come from short-term loans, and the risks of chasing the next hot investment trend. We've also discussed the consequences of conservative investing and neglecting to refinance loans, the high fees and commissions that can eat into your returns, and the long-term financial impact of only paying the minimum on debts and ignoring retirement planning. Moreover, we've delved into the financial perils of uninsured risks and poor tax planning, and the potential devastation that can come from falling victim to scams and fraud. And let's not forget the dangers of over-leveraging and the myriad of other overlooked factors that can silently chip away at your wealth. Remember, Understanding these wealth killers is just the first step. The next is to actively work towards avoiding them to secure your financial future. In every financial decision you make, consider these wealth killers. Be proactive, be informed, and most importantly, be financially savvy. And remember, we're here to help you navigate this journey. Our channel is packed with more insightful videos that will help you steer clear of these wealth killers and achieve your financial goals. Thank you for watching. Be sure to check out the other videos on our channel to help you achieve your financial goals. And don't forget to like, share, comment, and subscribe to our channel. Until next time, stay financially savvy.